Welcome, everyone. Happy Tuesday. I do want to say thank you both. Thank you also very much for taking the time to join today's webinar, where today's topic, we're going to be talking about building a steady stream of income in your self-directed account through diversifying through commercial real estate. My name is Reneika Lightbourne with Advanta IRA. I'm really excited to be joined today by passive expert investor Camilla Jeffs of Steady Stream Investments. Welcome, Camilla.
Thank you. I'm super excited to be here.
Wonderful, wonderful. So before I hand it over to Camilla, again, she's going to talk about diversification of assets in the commercial real estate space, which includes multifamily apartments, senior housing, industrial space, and so forth. Before I hand it over, I just want to give you a high-level overview of what self-directing is, how it works. If you have questions, we will allocate time at the very end, but if a question comes up, while she's going through her presentation, don't hesitate to put those in the question box and we'll get those answered before we end today's webinar. Again, my name is Reneika Lightbourne. I'm one of the business development specialists. I've been with Advanta as an employee since 2019, but I'm also a client of Advanta since for about 4 years now. So self-directing is something that I actively do. So I strongly advocate that more Americans should be self-directing their retirement account. If you have any specific questions, if you want to know more, you want to talk through your scenario, feel free to give me a call, send me an email. But also, too, I would encourage you to visit our website at advantaira.com. It's a great resource for you. Just a little housekeeping before we really get going. Just know that all of the information referenced today is just for educational purposes, and that Advanta, we don't give any tax, legal, or investment advice. We always encourage you to consult with your professional team, do your due diligence, talk with your CPAs, your attorneys, your financial advisors before making any investments. 3 quick takeaways. Just know that any IRA or former employer plan qualifies to be self-directed. More importantly, you choose the investment that works best for you. Today, we're going to be focusing specifically on commercial real estate. And then, of course, any of the income generated from that investment flows back into the IRA account. If there's any expenses associated with that investment, it's paid out of the IRA. So, for example, if you are doing storage unit, you would actually, the income generated from that goes back into your IRA account. If you have to pay property tax, it'll be paid out of the IRA. So just a little history about Advanta and who we are. We've been in business for nearly 20 years as one of the leading self-directed IRA administrators in the industry. Our headquarters is in Largo, Florida, which is the Tampa Bay area. Advanta also has an office in Atlanta, which is where I'm based. But we do have clients nationwide as we have nearly $2 billion under our administration. That's a sense of security for you. Any uninvested cash sitting in your Advanta account is FDIC insured. And then, of course, how we separate ourselves from our competitors is providing you, our clients, that concierge-style service, that dedicated account manager, and then having great educational content that features experts and content creators and practitioners in their space, like Camilla from Steady Stream Investments. All of our webinars are recorded. You will be able to access the recording on our on-demand YouTube learning channel, also our video library on our website at advantaira.com. We always have, events weekly. Later this week on Friday, my colleague Clay and I will be hosting Pitch, Promote, Prosper. It's open to the general public, so it's almost like a haves and wants, networking for different investment opportunities. Again, we're not endorsing anything, but if you want to collaborate or connect with other like-minded investors, it's a great platform for you to do so. I would also encourage you to check out our blog. It's a great, tool. Anything relating to the latest industry news or trends, you can find it there. So exactly what is a self-directed IRA? A self-directed IRA just simply means that you as the account owner have complete control over your retirement funds. You have complete control over the investment decisions. And then the beauty of self-directing is you get to really diversify your account. I know diversification is going to come up a lot with Camilla's presentation, but that's the power of self-directing. So in addition to using IRA funds to invest in real estate, whether it's a commercial project or a single family home, a fix and flip, you can also use IRA funds to invest in tax liens, notes and mortgages, heavy equipment, oil and gas, precious metals. We've definitely seen an increase in clients inquiring about cryptocurrency. It's near limitless in terms of the things that you can invest in. The IRA says the only two things that you cannot purchase is life insurance and collectibles. Outside of that, most things are on the table for you to where you get to, again, be as creative as you want to or need to within that retirement account. So why do people choose to self-direct? You may look to self-direct for many different reasons. I'll just touch on three of them. One, if you have funds that's sitting idle in an old 401k or an existing IRA and you feel like you can get better returns, or you don't want to tap into your personal savings or take out a loan, you can elect to move those funds to make that next investment. Two, the stock market. One day it's up, one day it's down. Whereas with real estate, commercial real estate, we know it always retains value, so you can elect to diversify your account and put some of your retirement money in that space. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, just depending on the type of account that you have. In terms of the different types of account, for individuals, just know that any type of IRA qualifies to be self-directed. So for traditional IRA, meaning you elect to get the tax deductions now and pay taxes later, or if you have a Roth IRA, you're electing to pay the taxes now, and when you take it out at retirement age at 59 and a half, it comes out tax-free. If you were a business owner, entrepreneur, have a side business, you can look to self-direct a SEP, simple or solo 401k. With end of the year, we're getting a lot of inquiries about the solo 401k specifically. It has great flexibilities, higher contribution limits where you can possibly put up to $58,000 if you're under the age of 50. So it's a really good opportunity if you're a business owner or an entrepreneur. Some lesser known accounts that can also be self-directed are ESAs, HSAs to cover medical related expenses. Having an HSA is more so depending on having a high deductible plan. So right now we know it's open enrollment, a few days left. So definitely you want to keep in consideration the possibility of opening up an HSA. Any former employer plan, whether it's an old 401k, 403b, or TSP type plan, they can also be self-directed. The main thing you want to remember is the contribution limits varies between the different account types. And then with the Roth, as long as you've had that account for at least 5 years and you're at 59 and a half, those distributions would be tax-free. In terms of getting started with us, we've really streamlined that process for our clients in 3 simple steps. When you're ready to proceed, step 1, you can complete the application online via DocuSign or our website. We'll be there to walk you through that process. Once you do have an account with us, you will have an assigned account manager that's going to be with you for the life of your account with us. So again, you get that concierge style service. Step 2 is funding your account, and you have a couple ways you can fund your account. If you have an old 401k or former employer plan, you can do a direct rollover of those funds. You would actually have to initiate that request to have that former employer plan send the funds to your Advanta account. If it's an existing IRA, it'll be a transfer trustee to trustee. There's no tax liabilities for you to do so. Advanta will actually initiate that request on your behalf. Whatever dollar amount that you do decide you want to move, because it's not end all be all, you just have to make sure that it's sitting in a cash position. And then, of course, you can make an annual cash contribution or use a combination of all 3. And then finally, step 3, start investing. What is it that you have an interest in? Is it that commercial project or that senior housing that Camilla is going to talk about later in her presentation? And with that, I'll go ahead and pass it on to her. Just let me make you the presenter.
All right. So can you guys see my screen okay?
Yes, we sure can.
Perfect. Well, everyone, thank you so much for joining today. I'm really excited that Reneika reached out and I'm able to come and talk to you all today. So we're talking about diversification. And so just a quick background about me. So I'm Camilla Jeffs. I'm the founder and CEO of Steady Stream Investments. And with Steady Stream Investments, we are a education company. I'd like to say we're an education company where we educate investors on how to become a passive investor in commercial real estate. And currently I focus on 2 assets. So one is multifamily and one is senior housing. So with the multifamily and senior housing, I love to educate people and especially focus on the first time passive investor. And I love that I'm partnering here with Reneika today to talk to you, those of you who have self-directed IRAs, because this is a very powerful strategy to use in when you get into real estate. So I'm excited to talk to you today. So first, let's start off. Let's meet Chris. This is my friend Chris. And Chris has a dilemma, right? So she has some money. So she has about 250,000 in cash, and she has 800,000 in her IRA. So if you were Chris's friend, how would you, what kind of advice would you give to her about how to use these funds that she has? Well, one of her main goals is to build wealth, right? She has got a great job. She's working hard. She's got a, she really loves her job. Like, she's not really interested in leaving her job yet. She's just loves what she's doing and loves climbing the corporate ladder. But she really wants to build wealth and focus on that. So at any point, she could leave her job if she needed to. And then for Chris, she is very proud of of how diverse she's been able to get in the stock market, and she wants to continue that. So diversification is really important for her because she likes to have the security of it all. And if you think about, that's really why we diversify, right? So we don't put all the eggs in one basket, and so that we have multiple ways and avenues to build wealth. I mean, my company is called Steady Stream Investments, and the idea is to help you accumulate multiple streams of income coming in, because we all know how scary it is to rely on just one source of income. That's really scary. So we want to make sure we're diversified. So how are we going to advise Chris? Well, first of all, we need to talk to her about what are the options out there, right? So I'm going to dive into a couple different ways to diversify. And the first one is diversifying by asset type. So asset type, what do I mean by that? Well, in commercial real estate, there are several different categories. So one is senior housing. And senior housing could be, there's multiple types of senior housing. So there is independent living, where it's like a 55 plus community. They live independently, but there is medical close by. There could be like vehicles close by to drivers to be able to drive the seniors to and from activities that they need to go to. There's typically like clubhouses and things for the seniors to do, and they're mostly independent. They still, they don't need a lot of help, but it's nice to be able to be surrounded by friends of your own age, right? We all like that. And then the next one is assisted living. And this is the type that I'm working in. So we are working on building assisted living facilities, and we kind of do a niche style where it's big homes. I call them big homes. We call them cottages, right? But think of large homes with 10 to 15 bedrooms per home, but it feels like a home. Like there's a front room, there's a dining room, there's a kitchen, there's a library, there's, rather than the giant facilities that are more like hospitals. My group, we focus on these niche boutique style assisted living. And then the next level after that is your skilled nursing facilities. And that is the highest level of care. So assisted living is kind of in between. They're no longer independent. They need some help. They need to make sure their meds get done. They might need help bathing and things like that. And then the skilled nursing facility is really at the very, very end of a senior's life, when they need the most help with all sorts of parts of life. So there's pros and cons to every asset type. So as I present the asset types, we're going to talk about it. We're going to talk about the pros and the cons. So what are the pros for senior housing? Well, one is it's very high demand and there's low supply. Especially in the US, as you study the demand and supply curves for the senior housing, you'll see that the demand just continues to grow because we have an aging population, right? All the boomers are aging and they're entering retirement age, and by year 2030, it's anticipated that the 85 plus population will double. Right. So if you think about, the seniors who are 85 plus, the majority of them will need some sort of assistance. They will need to have some kind of care. And so that's where the opportunity here is right now in the senior housing, is to start building all of these care facilities that will be needed as soon as the aging population happens. typically your senior housing is going to see your highest return on investment. Now, why is that? Well, remember, high risk, high reward. So it's going to be more risky. And the reason why senior housing is more risky is because it combines real estate with a healthcare business. It's not just one, right? It's not just that you're investing in an assisted living, the real estate. You're investing in the real estate plus that healthcare business. And so there's doctors, there's nurses, there are care professionals, there are professional chefs, people that come in and feed them. And so there is more risk in a senior housing asset. There's also cons to tenant turnover. It's very unpredictable, as you can imagine, with tenants as they come in. So really, they don't come in, and it's not like multifamily where you can say, okay, you're going to sign a 1-year lease and you're held to that 1-year lease, because sometimes grandma and grandpa pass away during that time, and so it's just a month-to-month type lease, and sometimes they'll pass away at the assisted living. Sometimes they'll have to be moved to a skilled nursing facility. It just kind of depends on how their health goes. And so there is quite a bit of tenant turnover. And then, another con is interpersonal conflicts, right? So we all know if you were to live in a house with other people that you didn't know, then likely there would be some conflict and some fighting. And so there is some of that happens in the senior housing, and you just have to have a really great care team to be able to mitigate all of those conflicts that could happen. But I really love senior housing. It's a really great opportunity right now to invest. So if you see an asset in senior housing, go ahead and take a look at that, because especially now, like getting in now is a great time, because 5 years, 10 years from now is when the demand will reach its peak, when the baby boomers will need the most help. And so these assets will just continue to appreciate with natural appreciation because of that demand. Okay, let's talk about another asset type. So there's industrial. So the industrial, this is like warehouses, right? And sometimes they're mixed use industrial. So there could be like a shop front in the front of the building and with a warehouse in the back. That's a really popular asset right now. And so what are the pros and the cons? Well, the pros are we're living in an online economy, right? I mean, I don't know about you, but I do most of my shopping online. And of course, I use Amazon for a lot of the shopping, but there's other places that you can shop online as well and get things right delivered to your door. So all of these online retailers are popping up all over the place, and they need places like this these industrial mixed use type to be able to sell their product. So huge opportunity here for this online economy. Typically, industrial will have longer leases. So they're not going to just do like a 1-year lease like a normal apartment complex is. They're going to have the longer 5, 10, 15-year leases, which is really nice to make sure to like guarantee your income. They're typically really stable, right? The companies, the businesses that will lease these are businesses that are doing well. They're not ones that are just hoping to do it. Like that's what you do your startup, and then you have your stuff in your basement, and then once you get to a place where you're established, then you move into an industrial warehouse. So what are the cons? Well, cons are they're single tenant, right? And so if a one tenant moves out, then your income goes to zero. So you have to kind of mitigate that and know that could happen. Once their lease runs out or business goes bad and they have to shut their doors, then there is a problem there, because it's just single tenant. So it's just something to be aware of. There's less availability. So right now there's not that many industrial assets out there for the demand that's happening, but it's also hard to find one yourself, right? So if you want to go out and you say investing as a passive investor, is that this is going to be quite a bit longer term than maybe some of the multifamily assets are. Multifamily, we try to do about 5 years, and then we'll see back and find industrial is going to be longer. They're going to be 10, 15, 20-year type investments. And so those would be more like cash flow investments that you would look for. So that could be seen as a con, it could be seen as a pro. It kind of depends on how you look at it. All right, next one is self-storage. This is one that's high on my list to invest in 2022. I definitely want to get into self-storage. And why? Well, because it has very minimal infrastructure. There's no toilets, there's no kitchen, there's no plumbing to deal with, right? The only thing you have in there is maybe electricity and heat. It depends on heat and cooling, depends on the type of self-storage that you have there. Also, self-storage has very low expenses and a really high return on investment. You can imagine that I mean, without the plumbing itself, there's just the expenses are quite low. And the really cool thing about self-storage is that it thrives in upturns and in downturns. So you think about the economy and you think about a family. Well, the economy goes well, they're making more money, and so they buy a lot of stuff, right? They're excited about their stuff, and they buy a whole bunch of stuff. Well, and and now they need to store their new toys, and so they'll go and they'll get a self-storage facility and they'll put some of their new toys in there. Well, then what happens when the economy turns down? Now this family's like, uh-oh, dad, mom and dad just lost their jobs. Now they have to find new jobs and they can't find jobs that are as good. So now we have to downsize. So they downsize their living arrangement. But guess what? They're not going to get rid of their stuff, right? Who gets rid of their stuff? Hardly anybody. They're emotionally attached to their stuff. So they're like, well, this is just temporary. People think it's just a temporary thing. So I'm just going to temporarily put my stuff in self-storage till I can get back on my feet, and then I'll get it out and we'll have our stuff, right? So you can see how the nature of self-storage is just, it's very recession resistant. No matter what happens in the economy, people are always going to be using self-storage. That's the reason why it's number one on my list to invest in this asset class for next year. But what are some of the cons? There's always cons. Well, cons are almost all self-storage is month to month tenancy, right? So there's going to be a lot of turnover, a lot of coming in and out. And so the income on it will fluctuate with that tenancy because they could cancel at any time. Also, tenant demographics. So it kind of depends on your self-storage. Like it could be a pretty emotional thing for tenants with their stuff in there. And I mean, and then sometimes they forget about it and they don't even remember that they had stuff. And so there are some challenges there with the tenant demographics. If somebody passes away that owned the self-storage that was leasing it, and now the family tries to get it, like there could be some issues with things going on there. So there could be some emotions to deal with. And then the other con is just finding and keeping good management. That's been a challenge for a lot of the self-storage investors that I know. And in fact, most of them are just essentially launching their own management companies because there's not a lot of really great self-storage companies out there who manage. It's mostly the investors themselves, the partners who own it, that are doing the management. So that's one of the challenges for self-storage. Okay, next one, office and retail. So office and retail, so 2020 was kind of a really bad year for office and retail, right? It just shut down. I don't know about you, but when I was in my W-2 job, I don't think they're back in the office yet, right? And it's been almost 2 years without using this office. And so you can imagine the hit that this asset took. But there are pros here, right? So there's longer leases. Typically, the tenants are going to be in there for a really long time. They call them triple net leases, and those are a lot of people really like that. The deposits on this. So if you're going to purchase one, right, you want to be the investor, you want to go and purchase an office or retail. So a lot of times the deposits you have to make on this are smaller than some of the other asset types around. So keep that in mind, that you could get into one of these with a smaller deposit. And then the tenant is responsible for all the expenses. So that's really nice that you put all the expenses onto the tenants here. So what are some of the cons? Well, could be difficult to find tenants. Another con to it, if you've ever seen a mall that suddenly, it felt suddenly, probably took a couple of years, but went like my hometown, there was a mall that we would go to as kids all the time. Well, I went back to my hometown and suddenly that mall is deserted. And the number one reason why was because their biggest tenant moved out. So think a Macy's or a Dillard's or something, like one of those really big department stores. They moved out of that mall to a new location, and a lot of times those are seen as the anchor tenants, and everybody else would stay if they stayed, but if they move, they're out too. So could be difficult to find tenants. So you have to keep that in mind. Changes in the area, you never know what's going to happen in the area. Another city that I know of had a really great indoor mall, and then a new company came in and built this fancy outdoor mall, and suddenly everybody went from the indoor mall to the outdoor mall because that was more exciting and different and new. So keep that in mind, that changes in the area could affect this asset. And it's also, like I said, very sensitive to downturns. So that's one of the cons for office and retail. And then this is my favorite. I can't help it. Multifamily is my favorite. So what are the pros of multifamily? Well, multiple tenants. Before I got into commercial real estate, I did a lot of single family rentals and small, like fourplexes. Well, what happens when someone moves out of your single family home? Well, your revenue drops to zero. So you really have that risk of losing a lot of revenue. Whereas with multifamily, in 100 units, if somebody moves out, the revenue barely takes a hit. And so that's the really nice thing I like about multifamily, is that there are multiple tenants to be able to spread that risk of revenue. It's just simply lower risk. And why is it lower risk? Well, because it's in high demand. Everybody needs somewhere to live. If you think about the other asset classes, senior housing, for example, yes, our seniors need care, but a lot of people choose to care for their parents on their own, and that's a choice that they can make. Whereas multifamily, what could you do on your own? Well, I don't know, maybe you could go live in the woods, right? But you need a place to live. Everybody needs a place to live. And so that makes it like one of the lowest risks investments that you could get into. And then multifamily is going to have huge tax benefits. I love this especially as a passive investor, because investing into one of these, we call them syndications, it's just a fancy word for group investment, means that you are a direct owner in the asset. And because you're a direct owner in this multifamily apartment complex, you receive the same tax benefits as if you owned it on your own. Of course, your percentage, right? You get your percentage. But I love this about multifamily. And then often we will do things called a cost segregation study, which will bring in a it's called bonus depreciation. So what does that mean? And let's talk about in real numbers. So say you invested $100,000 into this multifamily asset. The next year you get a K1 that shows a loss, right? It's not a real loss. Remember, it's paper loss of anywhere from $50,000 to $75,000. And that can then go, hashtag not a CPA, check with your CPA, but it can sometimes offset income in your taxes. So very powerful method. Okay, so there are cons too. I know I love multifamily, but there are cons as well. The cons are it's management intensive, right? You can imagine 100 apartments and having to manage them and just figure out who paid and who didn't pay, and you have people saying, well, I can't pay right now, but I will pay next week, and then the follow up. I mean, there's just a lot going on in them. So you need to have very good property management to take care of each of these assets. The cost of multifamily, so it is, if you want to go purchase a multifamily asset on your own, you're going to need a lot of money to be able to purchase this, which is why I think it's so powerful to use the group method, the group syndication method, because we can pool a whole lot of people's money together and be able to purchase them as a group, where none of us could do that on our own. And then competition. The competition is fierce, especially right now, because the multifamily is one of the lowest risk investments, and it brings in one of the higher return on investments as well. So the competition right now is just very fierce in the marketplace, and you've got to really get to know the right operators in the right markets that you want to be in, so that you can have access to invest in one of these assets. So, going back to Chris, right? Which asset? Well, Chris, what do you think? What would, of all those that I just explained, what do you prefer? Well, she picks multifamily. It's like, great, okay. But now if you pick multifamily, is there a way to even further diversify? Well, yes, there is. So remember, we diversified by asset. Now we're going to diversify by asset class. And this is where things get fun. So multifamily, so if you think about multifamily, not every building is the same, right? You've got really junky ones and then you've got fancy brand new ones. And so we're going to talk about the differences between those. So the way we refer to them is we use the grading system. Class A. Remember, A is like the best. If you got an A on your paper, you did the best, right? So same thing for multifamily. So class A is your brand new, right? They're either brand new construction or have been built within the last 10 years. They'll have all the high-end amenities, like all the bells and the whistles and fancy things. There'll be like smart building technology in there. They'll have really fancy pools, sometimes multiple pools, saunas, and things like that. A class A will have quite a low cap rate. Now, if you don't know about cap rates, cap rate is just it's a metric that we use to understand how expensive a building is, right? So there's a formula that we use where we take the net operating income, we divide it by the price of the building, and that gives us the cap rate. So typically a cap rate in a class A is going to be low. And there's an inverse relationship here with the price of a property and the cap rate. So low cap rate means high priced property, right? But they command the highest rent. So, those who are doing well, then they will get a class A and they want to live in the fancy place down, and typically they're located in downtown, very close to um, um, all the amenities around and shopping and restaurants and things like that. So that's your class A. So, if you think about Class A, the benefit of investing in a Class A is that everything's new. So there should be very low maintenance expenses. There should be no, we call them CapEx expenditures, which is like improvements that to be made to the property. And so it's just a steady, stable, asset. Typically, your Class A will probably not achieve the highest return on investment, and we'll talk about which one will. However, your Class A is safer because there's not much that really could go wrong in a Class A asset other than poor management. Okay, let's talk about Class B. So remember, B is like just below an A, and it's going to be about 5 to 10 years old. They'll be really good amenities, but maybe not high-end amenities. The rent will be about medium, so it'll be below Class A but above Class C. So think this is your, these are your McDonald's managers, right, that live here, or people with good jobs. They have good jobs. They have steady income coming in, and they'll do that. The Class B is really the most resilient of all of these classes because if you think about the economy, again, if the economy goes down, people move and people downsize because they can't afford to live in the fancy place anymore. So the Class A has that risk of economy, going down, and then people like, oh, I can't afford this apartment anymore. I need to move down to the lower level. And so then they'll go down to B, right? So A goes to B, B goes to C, C goes to D. And then if the economy goes up, then the reverse happens. So D class moves up to C, C moves up to B, B moves up to A. So the reason I really like the Class B and C's is because they are right there in the middle. So typically they will have the highest occupancy as compared to the Class A's or the Class D's. So they're going to be quite resilient assets. And the nice thing about Class B's is that they're newer, as they're, kind of newer. They're not as new as Class A's, but that also means that the maintenance on them is not going to be as intense as a Class B or a Class C. Okay, so Class C. Class C are going to be your 10 to 30 years old. They'll have sparse amenities. They might have a pool, maybe it just kind of depends on the area, but they'll have a couple of amenities, but really not a lot of amenities there. They'll be lower rent. These are your working class folks, construction workers, things like that will rent here in the Class C's. But the nice thing about Class C's, and really Class C is kind of where you could potentially make make the most money, because there are value add opportunities. Now, what's value add? Value add is where you see a way that you can add value to the property by either renovating the units and increasing the rent, or maybe there's some land there and you can build more units, and then that will increase the amount of money that your property is bringing in. Sometimes the value add opportunity is just simply reducing the expenses. Maybe the expenses are too high. Maybe there's been a water leak forever and it's just the water bill has been enormous. Go in and fix that and suddenly you're saving a whole bunch of money. So that's where the opportunity here is for the Class Cs. Now, again, higher risk, right? Because the Class C opportunities are going to be older buildings. So there'll be things that happen. Like just today, I was on a call with our property management company and they said, well, we had a leak, a toilet that was leaking. So the plumbers went in to fix it, but they couldn't shut off the valve. The shut off valve is too old and they couldn't even shut it off anymore. So then they had to go out to the yard and they had to dig up the lawn to be able to find the next shut off valve, and it was just very labor intensive and took a lot of time because it's a Class C building and those valves are old. So there's things like that that pop up in Class C. So you have to keep that in mind if you're investing in a Class C. It's just going to be older buildings and there'll be issues that arise. Now, a really good sponsor, though, they will be able to mitigate that and they will have reserves for things like that because they know that these types of things pop up. And so they'll have the reserves just waiting to be able to fix these issues as they pop up. But again, Class C is a solid choice to invest in. Now your Class Ds, some people say D for dump. These are going to be your 30 plus years old, really old ones, no amenities, often the very lowest rent, and in high crime and poor areas. So it kind of depends on your strategy here, but Class D, it's going to be your most risky, but then again, could be the best return, right? You just have to keep in mind that in the Class D, and most investors I know kind of stay away from Class D, so it just depends on your strategy here, but this is what a Class D looks like. Okay, so now Chris is asking, well, okay, now I know about the different asset types, and then within each type, there's different classes. So the same thing goes, like it's not just multifamily that has class A, B, C, D, right? The same will apply for all of the commercial real estate assets. But what else should I know? Well, okay, so she's thinking multifamily class B. That sounds good to me. But where should I invest? So now here's another thing to keep in mind for diversification, right? You can not only diversify by your asset type, so you choose what type of asset, then you're going to diversify by what class, but now you also diversify by your market. So how do you choose a market? And this is tricky. This could be tricky. So number one, you want to look for population and job growth. And even if you're a passive investor, which I think really is the ideal, right? Let's just invest passively and we don't have to do all the work. It's still good for you to look at markets. And some of the passive investors who invested in some of my projects have invested in them because they have lived there before and they know, like, have firsthand knowledge that population and the growth of the area. And others, they just simply look at the information that we provide and do a little research on their own and look up the job growth and population growth. But what's really important in a market in order for a market to have the most stability, you want to see population growth and you want to see job growth. You also want to see job diversification. So it's risky to invest in a project that is located in a town that say that the major employer is the oil and gas industry and that's it. And there might be like, a handful of other employers around there, but if 50, 60, 70% of the population works for the oil and gas industry, that's risky because when the oil and gas industry goes down and they lay off all those workers, suddenly that really affects your investment. So keep that in mind as well. Another thing is when you're looking at market, right? Are you looking for a market that has really great cash flow, or are you looking for a market that has really good appreciation? So case in point, California. So California, you can buy a property there, and you can pretty much bank on having really great appreciation. So that though that multifamily asset is going to appreciate and do well in that market. However, the cash flow is going to really struggle. There's going to be hardly any cash flow. So your investment in a California asset will most likely be banked on high appreciation. Now, I don't know about you, for me that feels a little bit risky. I appreciate having some cash flow. So if you want to stay away from appreciation markets, you can look for cash flowing markets. And your cash flowing markets will typically be in like the Midwest. That's where you'll be seeing lots more cash flow because the prices of the properties are lower, but the delta between how much the mortgage is and how much the rent income comes in is actually really good, and so you can get nice cash flow. So you have to kind of figure out your own goals. So remember Chris, our example, Chris. So she's got a great job. She's got really good income coming in. She doesn't really need cash flow. So she would probably lean towards more of an appreciation type market, which would be California. Another good one is Arizona has really great appreciation happening. Texas, Florida, Carolinas. There's several of those markets that are really taking advantage of this strong population job growth appreciation that's happening there. But if you are someone that, unlike Chris, that you're really dissatisfied with your job and you would love to leave your job and do other things, well, you need to replace that income. So then you would be looking for a cash flow market. I already talked about job diversification, like making sure that you have multiple industries in there is really important. And then take a look at the percentages of people that work in those industries. And you don't want to see any industry that has more than 20% of the employment market, right? So you want to see less than 20% for all the industries. And then finally, a great market has good landlord and tenant laws. So they're very favorable for the landlord, meaning there's some markets, like Illinois, for example, has all of their laws are more favorable toward the tenant than they are the landlord, which means that the tenants have a lot of protection and makes it really difficult for you to evict a tenant. Now, we don't evict tenants just to evict them, right? Like just because we don't like them, like, oh, okay, you're out, right? But we have a business to run and we need to make sure that the customer is a paying customer in order to use our product. And so it's better for to invest in more landlord-friendly states so that you can execute your business in a professional way. All right, so do you feel like this girl? Are there too many choices? Did we just go through too many choices? So sometimes when you're looking at investment opportunities, you can probably feel like this, where you get overwhelmed and you're thinking, oh my goodness, there's just so many choices. I don't even know what to do. But don't worry. Like so, that's where people like me come in to play, right? Again, like I said, my business is an education business, and I'm all about educating investors on what's going to be right for them, because what's right for you is not going to be right for your neighbor, and it's not going to be right for your colleague in church or school or your work or wherever. So yes, there's a lot of choices, and choice brings about opportunity, but also could bring about overwhelm. So stay close to people like me, then we can help you and really educate you through the process. But really, here's some things that you can do. Just start now by educating yourself and just knowing in your brain that, okay, someday I do want to diversify my portfolio and want to have it well diversified, right? Like it's not that you're looking for one asset outside of the stock market. You want to be well diversified across asset classes, across asset types, and across markets. And that's the cool thing about being a passive investor, is that it's pretty simple to do that, to diversify like that, and to be that well diversified. If you're an active investor, it gets a little harder because actively investing in multiple states, you can imagine that is tricky to go there and have to be in those markets. But just educate yourself, right? Really get to know other people in the space in the area that you're interested in. I have a lady who wants to be a passive investor, and she wants to do it in hotels. That's one I didn't even highlight here today, but that's another industry that you could absolutely invest in. And but specifically, she wants to do like themed hotels, something about a pirate ship. She wants to invest in a hotel that is a pirate ship. I'm like, okay, well, that will be hard to find, but just start educating and start figuring out people who are interested in the same thing that you are. Step 2 is define your goals. So you want to really define, are you looking for cash flow? Are you looking for appreciation? What type of wealth building are you looking for? And the better you can define your own goals, the easier it will be for you when an investment opportunity arises that matches your goals. You'll be like, yep, that's it. That's what I was looking for. So if you don't know what you're looking for, then you just don't know which one you're going to invest in. So it's very helpful to define your own goals. Step 3 is define that investment opportunity, right? And you do that by getting to know people like me, and attending these webinars that that the Advanta team puts on for you to get to know people in the industry, so that you can get connected with them. Because a lot of times we don't offer the opportunities to the public. It's only to private people that we know ourselves. So really get connected, have a phone call with other sponsor teams, so that you can understand what their philosophy is and see if it aligns with your goals and your own investment philosophy. So, there's all these different types that you could invest in. You could invest in new construction, the value add, turnkey. Turnkey is one, means that it's already built and it's nice and you don't have to do anything to it. You just take over and then you start investing. But what's the investing process look like? So as a passive investor, really you can just relax. I like to think of it like as a cruise ship, right? So you're the one that you choose your destination, right? You go and you choose which cruise you want to be on. And then you have all the helpers that help you. You have the captain who drives the ship, right? That's like the lead sponsor in a syndication. You have all the people around that are helping you. You have the chefs, you have the what are they called? Butlers? It's not butlers. The person who brings your luggage to your room. I don't know what they're called. But you have all these people that help you. And so really you can relax. You can relax knowing that you're in good hands. After you've picked your destination, you purchased your ticket by wiring your funds, you kind of checked your bags, you made sure, and you did your checking to make sure that the investment is going to be a good one. You looked at the safety of it, right? What are the risks? Make sure you understand the risks of every investment that you go into, and then you're just ready to get some sun, right? Once you select an investment, the worry is over, and you can know and just relax knowing that your investment is in good hands, and you'll be getting updates throughout the whole investment process. So now you know, right? Chris is excited. She's excited to invest in her first thing. Now you just need to find a deal and get involved, and then feel free to reach out to me with any questions. And you can find me at CamillaJeffs.com or on I'm on Instagram as the Introverted Investor. So thanks, and I'll take any questions now.
Thank you so much, Camilla. Great presentation. We did have some questions come in. The first one I have is, how much did the COVID rent and eviction moratorium affect your multifamily returns and dividend payments? Okay, so I'm getting feedback from the audience that they can hear me. Camilla, can you hear me now?
Okay, yeah, I can hear you.
Okay, so question is, how much did the COVID rent and eviction moratoriums affect your multifamily returns and dividend payments?
Yes. So the thing that happened with the multifamily, so let's talk about two different things. So it affected distributions, right? So in 2020, when COVID first struck, then a lot of the lead sponsors withheld distributions. What does that mean? Well, that means as a passive investor, if you were getting checks every quarter, they decided to not give out those checks and then keep the funds just in case something crazy happened. The other thing that happened is that we all got to work really trying to figure out how can we help our tenants, and we wanted to be very proactive. And so we figured out all the different government help that was happening during COVID. And so really the ultimate deal was that if someone had a COVID-related challenge, we were not allowed to evict them, right? So of those who had actual COVID-related challenges, you can imagine the different class of investments. Like nobody in Class A or Class B had any problems. It was the Class C, Class D investments that had some challenges. But of those, all the investors that I've talked to, all the lead sponsors that did that, because they were so proactive about it, they really only had a handful of people that they had any trouble with not paying rent and not getting any revenue coming in, and they just kept working with them and working with them, and we did our best to work with them. So what we did is we withheld distributions for 2020. Now we're in 2021 and it's a different environment. We started back up on the distributions in 2021. And the cool thing is that there have been, depending on your market, right? A lot of the markets have not had any negative effects to COVID. In fact, there's been positive effects. As you know, inflation has increased a lot this year. And that is a positive effect for real estate because rent goes up and then our revenue goes up and we didn't really have to do anything to affect that, right? So with inflation in real estate, we love inflation because it helps us out. So that's kind of what happened through the COVID pandemic. And I think things are really settling now. And a lot of people are selling their large multifamily and making a really great return for their investors. I know a couple of them in the Arizona market who have doubled investor returns in 2 years because of what's happened in the economy. So it's actually kind of been an odd tailwind for us and really helped us because of what happened in COVID and the shutdowns in the economy in 2020.
Okay, more questions coming in. So the next one is, do you offer mentorship of some sort for individuals who would like to invest in multifamily properties, preferably as a GP?
So great question. So currently right now I am hyper focused on investing myself and I don't have a membership program. However, if you want to reach out to me, I do have some referrals for you that I could refer you to some other people who do have mentoring programs, but not right now for me.
Okay, next question is, what is the role of SteadyStream in the investment process?
Yeah, so steady stream in the investment process. So I am a general partner on all the deals that I offer to my investors. And the way my business is set up is such that I'm 100% focused on investor education and helping investors find deals. So I go through a vetting process. So I pre-vet all the opportunities that I send out to my investors. And I do that by going through, like a 50-point vetting process. I vet the sponsors, I vet the market, I vet the deal itself, so I feel good about the deal. And then I'll bring it to passive investors and I'll say, okay, here's all the information, and here's what you need to know about these properties. And then I kind of guide them through the process. So I have the ability to offer multiple assets in multiple markets and multiple asset classes to help you to really figure out your to match investor goals and what they're looking for.
Okay, and that was
So think I'm
a
like the Yoda, right? I'm the guide.
Okay, next question is, do you have a list of current opportunities?
Yeah, so all my opportunities are on a relationship basis because I have to follow the SEC rules. But with opportunities, so typically in my business, I offer opportunities about every 2 months. There'll be a new opportunity. So if you want to know about those, you'll reach out to me and get on my list, and we can schedule a phone call so that you can have access to the deals as they come up.
Okay, next question is, what about REITs? They didn't elaborate further, but
Yeah, so
offer REITs.
yeah, a REIT. A REIT is different than the type of investments that I do in one thing, right? So REITs invest in real estate. However, if you invest in REIT, it's like you're investing in a mutual fund. You're not a direct owner in the real estate asset. And I think that's what makes the big difference between a syndication and a REIT. Because in a syndication, you as the passive investor are a direct owner, and therefore you get all of those tax benefits. A REIT, you're not going to have the same type of tax benefits that you will in a syndication. Also, syndications typically have much higher returns than a REIT because a REIT, because you're investing in like one product and one, the one asset, you get the full benefit of the appreciation and whatever happens with that asset. Whereas a REIT, you're investing in it, they go and they choose like 100 different assets that they invest all the money in. So you can see how, I mean, diversification is good, but too much diversification will really water down your returns. So you want to have some diversification, but not too much. And my opinion is REITs are a little too much diversification.
Okay, next question is, how are you finding multifamily opportunities? Cold calling versus direct mail versus lead referrals from commercial brokers?
Yeah, 90% of them are found through commercial brokers. So really the best thing that we can do as a general partnership team is get to know the commercial brokers, treat them well, and prove to them that we can close deals. And then they will bring us the best deals, because sometimes it's kind of like a network thing where the broker gets a seller, as the seller's ready to sell, and the broker immediately calls one or two people and says, hey, I have this opportunity coming up. Would you be interested in it before I send it out to the public? Those are the best deals, and that's what my partners try to do, is to get in with the broker so they can get access to the best deals when they first are ready.
Okay, more questions. Is there a minimum investment? Do you need to be accredited?
Yes, there's always a minimum investment, and typically of the opportunities that I provide, the minimum is going to be around $50,000. And then do you have to be accredited or not? So it depends on the deal. Sometimes the deals are open to accredited investors only. Sometimes they're open to accredited and sophisticated. And what's sophisticated? A sophisticated investor is someone who doesn't quite hit the net worth or income requirements of an accredited investor, but they can prove that they have investment knowledge. So maybe you've invested in a couple of rentals before, or you've self-directed your investment account in the stock market, right? You can prove that you know something about investing, and you have a relationship with a member of the general partner team. So like I said, that's the model that I use, is the relationship based one. So I can offer the majority of my opportunities to accredited and sophisticated investors, because I like to help those who don't have $1 million yet to be able to get to that $1 million. That's one of the things that I'm passionate about, is helping you to build wealth. And so you can invest in some of the deals as a sophisticated investor. If you're accredited, you have access to all the deals. But as sophisticated, you have to know the certain people who do those types of opportunities.
Okay, next question is, which markets are you focused?
So currently my assets are in Arizona. So most of my multifamily assets are in Arizona, and that's an appreciation market that I love. And then the other market that I'm in is Oklahoma, and that's a really great cash flowing market. So I have those two markets, but I live in the Dallas area, and I've lived here for about a year now. So I've gotten to know the market. And so I'm looking to expand into the Texas market in 2022. So that will be another market that I'll be offering next year.
Okay, next question is, how many GPs are there?
It depends on the deal. So, the Oklahoma deal that we have is a 100-unit deal, and Oklahoma is a smaller market, right? And it's not as expensive. There's about 5 or 6 of us on that deal. But then the last Arizona deal that we did, there's probably 9 or 10 general partners, because it's a much bigger asset and we need more people to help. So just kind of depends on how big the asset is.
Okay, and there's a follow-up question relating to GP. Are you taking investors in a GP capacity for your new deals? I'm interested in being a GP.
If you're interested in being a GP, my recommendation is to start networking with other, active investors. And you can do that by going to conferences. There's online meetups, there's local meetups. So search for meetups in your area, because what you really need to do is get to know the other people in the industry. And then the other thing you need to do is figure out what is your what value can you add to a team? Are you good at underwriting, or are you good at the acquisitions process? Can you raise capital for deals? Do you know how to manage the asset after the deals? And figure out kind of where your skill sets are, so that when you approach other active investors, they will know, you can tell them right away, here's what I can add to your team. And if they're looking for that, then they may be interested in bringing you on.
Okay, so a few more questions. Did you mention the rate of return that we can expect if investing with your group?
Yeah, so every deal is going to be different, but I'll tell you what we try to achieve. So what I look for deals is, I look for an IRR of about 15 to 17%, looking for an average annual return of anywhere from 18 to 20, and then looking for like in 5 years. My goal is to be able to double your money in 5 years on average. So I mean, some will be more and some will be less, but that's kind of the types of returns that we're looking for.
Okay. Next question. While it's not IRA related, they want to know, does doing 1031 exchange work with your investments?
1031 exchange is a little bit tricky, and this is what I tell people who have that situation. So it's tricky to go into a syndication as a passive investor using 1031. And the reason why it's tricky is because in the structure of a syndication, it's structured as general partners and limited partners. That's the passive investors. So if you're a passive investor and you join as a limited partner, that means you don't have a say in how the investment is run, right? So the general partners are the ones who make all the decisions. However, if you need to 1031, you can't 1031 in as a passive investor or as a limited partner. You have to 1031 into what we call a tenant in common, a TIC. That sounds like a bug, like you have a bug in your head, but it's called tenant in common. And as a tenant in common, that means you do have a say in how the properties run. So general partners, we don't typically like that or allow that unless your 1031 is a very high dollar amount, like I think 500,000 plus. Then we'll do a 1031 and allow you to have a say in the property. I think the risk we run is that if all the general partners who are the experienced investors agree that, hey, now is a good time to actually sell the property, but then that one 1031 investor could say no and could stop it, then that's the challenge that we have there. And so it's just a matter of getting to know people and finding ones that may allow the 1031. But again, it would most likely be for a much higher dollar figure than like a $50,000 investment. I don't know many sponsors who would allow that as a 1031.
Okay, thank you so much. Great question. I did have one come in relating to Advanta related fees. So we don't charge any commission. It's a flat administrative fee in terms of the per transaction. So, it'll be, 95 based on the type of investment, or 145 if it's a tangible real estate, but it's more like if you buy or sell, that's when you have that transaction fee come in. With that, I'm going to go ahead and share my screen just to close out. Just bear with me one moment. So my computer, unfortunately, is freezing, so my apologies. If you have questions about self-directing, if you want to know more, you want to, talk through your scenario, definitely feel free to visit advantaira.com, give us a call, send us an email. Camilla, I know you provided your contact information as well. Yes, you will. The recording will be up within 24 to 48 hours. You also will have the ability to get a copy of Camilla's slide. Just feel free. You'll get an email notification from us at Advanta, and you can just simply inquire or request, and I can reply back with a copy of her slides. With that, I'm going to go ahead and end the webinar. Thank you again. Happy holidays, everyone. Be safe. Have a joyous holiday season.
Thanks, everyone.